what we have to do is understand first the P&L. This is an actual P&L of one of our clients. This is one of the top teams in the entire country. They're a team at a brokerage. They're not a brokerage. They probably have, under 50 agents, and the owner is out of production. But all of that to say, the first section is the income section, and it's going to show the total income. Second section is the costs of goods sold, which goes from here all the way down to here. Now, I'll tell you, CPAs and typical non-real estate specific bookkeepers, they don't track total income and cost of goods sold. You may say, well, when I look at my P&L, I have income on there. Yeah, but you don't have total income. You have income after the broker got their portion and after the agent, if you split with an agent on a deal, got their portion. If you paid a buyer's agent a split, that's a cost of goods sold. If your broker took some of the commission that came in, that's a cost of goods sold. Most CPAs don't even track that. Huge mistake. Now, the reason CPAs don't do it is because it has no effect on taxes. And they're only thinking about that, which is what they should be thinking about. At least most of them are only thinking about that. To me, a good CPA, their whole focus is decreasing my tax liability. The downside is they're not thinking about the true health of the business. And even if they are, they don't understand the nuances of the real estate business. Unless they've been in it like we have and built our own real estate company, like they don't understand the nuances. So you've got to track cost, total income and cost of goods sold in your books. Then that leaves us with the third section of your P&L, which is the gross profit. But the gross profit is the amount that actually hits your bank account as the team leader, as the company owner. Then we have our expenses. And this is a bigger category. It's going to start here and it's going to go all the way down to here. There it is, total expenses. And so that's number 4. And then the fifth and final section is the net operating income. Now we call these the simple numbers, the 5 simple numbers. That's why we're called simple numbers. These are the 5 sections or simple numbers of your P&L. But number 1, you got to make sure your P&L is set up this way. Number 2, you got to understand your 5 simple numbers. So when I'm doing a P&L review, that's the first thing I do. What are my 5 simple numbers? Then I'm going to go ahead and look at the margins on each. So here they are. What are margins? Well, margins are the percentages, right? Like if we were to look at your business like a pie, so the margins are the sizes of the pieces of the pie. So we'll talk more about that, but that's what a margin is. And so in this case, in this example, this team did 10.4 million in total revenue. Second section that I outlined above was the cost of goods sold. That's 6.4 million. And then they were left with 3.9 million of gross profit. So they started with 10.4, paid out broker and agents a total of 6.4. We're left with about 4. Then number 4, they spent 2.6 on stuff to run the business. And that leaves them with number 5, net profit and owner pay, which in this example is 12.4%. And by the way, that includes 1.1 of profit and 125 of salary. That makes up the 1.282. The owner pays themselves a salary in this case to keep the IRS happy. They basically take profit and they take 125 of it and they pay it to themselves in the form of a salary because the IRS wants to collect payroll taxes. We really look at that, not from a tax perspective, but from a CFO perspective. I look at that in a lot of cases as money that the business made and it didn't get eaten through cost of goods sold or operating expenses. It was left. We just happen to pay it to ourselves, not in the form of a profit distribution, but in the form of a salary. To get the true understanding of the health of the business, it was more than 1.157. That was just the profit. Profit plus owner salary and any other like indirect expenses like my car, or especially if I'm out of production, I'm not using my car for business that often. I might run it through the books to decrease my tax liability, but it's still a indirect personal expense I'm running through the business. If your CPA says you should do it, do it. Decrease your tax liability. But when I'm looking at your P&L, I'm pulling that stuff out and I'm adding it back into profit because otherwise we aren't looking at the true health of the business. So now you can see these are the 5 numbers we need to look at. We need to pull out indirect expenses and really understand the true health of the business in order to understand what's going on. Now, this team leader, I asked them, I said, is that where you want to be? And they said, no. Okay, great. So 12.4% is not where you want to be. Why? Well, because Andy, I think I did better last year. I said, okay, let's look at last year. So we did the same analysis for 2022. They actually did 8.5 million in top line revenue and made 2 million in net profit. So they did $1.5 million. Actually, it was almost $2 million less. So 2023, 10.4, 2022, 8.5. They did $1.9 million more in revenue and they made like $700,000 less. That's a problem. What's awesome about this is we can dig into their margins to determine where the issue is. And what's cool about it, there's only two places you can get this wrong. So let's look at it. If we look at the business visually, here's their business in the form of a pie, right? The total pie was 10.4 million. They paid out 62% in cost of goods sold. Then the orange section, they spent on operating expenses 25.6%, and they were left with 12.4% or 1.2 million in net profit and owner pay combined. So the green section is the piece of pie that the business didn't eat to operate. The red section is the amount it ate to pay the agents and broker their portion. And the orange section is the amount it ate to pay the vendors and all the stuff, pay for all the stuff. So that's the first thing to understand is we got to look at the business visually that way, very simply. Then we look at 2022 in the same way. 8.5 million was the pie. So it was almost $2 million less. And 50% went out in cost of goods sold, just over 50%. We spent 26% on operating expenses, the orange, and we were left with the green, 23.5% or 2 million. So when we compare them year over year, where's the issue? What changed? The overall pie got bigger, but the net profit from a percentage and the dollar amount both went down. Why? Well, there's only two places that we have to look. When you're running a real estate team, your pie, your whole business is only cut into three pieces: profit for you, operating expenses to run it, and cost of goods sold when you share a split. So if the net profit, the green, is not where you want it to be, there's only two sections left we need to look. Sometimes both of them are off. Sometimes it's just one or the other. In this case, it's pretty obvious to me. So we know operating expenses wasn't the issue. That didn't change. It actually went down as a percentage. So the only other place it can be is costs of goods sold, the red section of the pie. And of course, that's exactly where it was. If we look at 2022, 50%, 2023, 62%. Okay. So when we look at the actual hard numbers, it's about 11.5% higher cost of goods sold than in 2022. So on average, the deals that we're doing, 11.5% more went out in 2023 on each deal than in 2022. Now we know where to start digging. We know that if we're going to solve this net profit issue, just doing more deals and increasing top line revenue doesn't solve the problem. We have to pay attention to our operating expenses and costs of goods sold. In this case, cost of goods sold is where we're bleeding. So what our job here, our mission, is to figure out where this 11.5% went. Why did we increase by 11.5% in cost of goods sold? Well, this is why we do the books the way we do them. Now we can dig into our cost of goods sold. Here's 2022 on the right, 2023 on the left. Your first reaction might be like, oh, I must have paid too much to my agents. Well, not necessarily. Well, let's figure it out. When we set up your cost of goods sold, here's how it should be set up, in our opinion, is this first section of your, remember the red part, this whole part is your cost of goods sold. It's broken up into a few different sections. The first section is your broker costs. So in this case, 96, almost 97,000. Okay. That's 1%. 1% went to broker cost of goods sold. Okay. Number two is going to be the commissions paid out in the form of buyer's agents, listing agents, referrals paid. That was 59%. They also have a section of their cost of goods sold. Not everyone will have this. They do, where it's bonuses. They pay some bonuses to team leaders and otherwise. And that was 1.3%. Okay. So we had 1%, 59%, and 1.3% in the three different categories of the cost of goods sold for 2023. That was a total of 62%. So let's look at 2022. We had 1% broker. Well, that's the same as 2023. 1% broker. We had 45.5% agent. Well, that's a bit lower than this year by a lot. Probably where our issue is. Let's look at the last category. We had 1.7% in bonuses. This year, we only had 1.3. That section actually went down. So clearly it is in this middle section that we have an issue. And then it jumped out at us right here. Referrals paid. Look at the difference here. 1.8 million in referrals paid in 2023, 61,000 paid in 2022. Whoa, that's a big difference. Referrals went from 0.7% of our revenue to 17.8%. There's our problem. It couldn't be any more obvious. So what are these referrals? You know what they are? The big Z, Zillow Flex. They shifted from 2022 to become a flex team in 2023. Yeah, their revenue went up. If that's all they were looking at, they'd be like, wow, great. Revenue went up. It must be working. I see so many teams do that. I'm growing. I'm adding agents. I'm adding top line revenue. But look at this. They lost $700,000. They would have been $700,000 ahead had they just done the exact same thing they did the year in 2022, the year before. They would have only done 8.5 million, not over 10, but they would have made more money. What can we take from this? Well, there's some strategy out of this. What we determined with this company is that when they shifted to Zillow Flex, they had too much effort and focus on those deals, and they lost sight of the low-hanging fruit, the low-cost, high ROI, high-converting leads like past clients, like open houses, like expired listings for sale by owners, all of these things that don't have such a price tag attached to them and that they're more in control of, and instead focused on the Zillow Flex. Guess what? 35% gets paid out, more in some cases on each deal, and there's your loss. So I want you to see how we need to look at the P&L with those 5 sections. If you need a quote for services from us, or you want to watch more videos on all this stuff, go to our website at simple-numbers.com. Thanks much.